My question is in regards to your recent memo titled Yet Again. So in the memo, you wrote a lot about passive investing and how a reliance on non-discretionary buying is taking us away from a focus on finding the right value. What are your thoughts on shareholder activism, which some may see as on the opposite end of the spectrum?
Well, thanks, Jason. So, when I went to, we didn't talk about this too much at Wharton, but when I went to Chicago, they had done a lot of research which showed that the average mutual fund had done worse than you would have done if you just bought the S&P or the Dow or something like that. So some people started saying radical things like, well, why don't they just buy one share of every stock in the index? And there was no word for it in those days, but that turned into what we call passive investing, and it led to the creation of index funds, the first prominent one of which was the Vanguard 500 index fund in 1975, as I recall. So, as I mentioned before, most active managers have not done as well as the index. And by the way, it doesn't stand to reason to think that on average, everybody's going to do average before fees and below average after fees. So it's only the exceptional people who can beat the index after fees. Not everybody, not the average person, but the exceptional. Further, we talked earlier about the emotional challenges of being a contrarian and adding value. And most people aren't in control of their emotions. Most people are, by definition, not contrarian. So there's been a strong movement toward index investing. It used to be something of a novelty back in 1975 or even 85. And today it's a real thing, and lots of people are replacing their active managers with passive, largely because the actives didn't do any good. But as you point out, Jason, in passive, people just buy the same stocks in the index in the same weighting as the index. Now, the irony of this, before I move on to your real question, I just want to point out what I think is the supreme irony of this, which is, why do the stocks in the index have the weighting in the index that they have? Where do these indices weightings come from? They don't come from up there. They don't come from the operation of nature or physics. This stock has a value of $80 billion. That company has a value of $180 billion. Why? Partially because what the companies accomplish, and partially because of what the investors say they're worth. So the market weightings, the prices, and thus the weightings are assigned by whom? By active investors. And yet there's a trend to passive investment on the premise that the active investors don't really know what they're talking about. And yet, the MO of the passive investor is to emulate the decisions made by the active investors who they think are idiots. So it doesn't make any sense. Anyway, that's what passive is doing today. And we have to wonder about the wisdom of passive investing. And so one of my clients called up and said that she has a new treasurer, and the new treasurer wants to put all the whole portfolio into an index fund, all the stock. Fire this manager and that manager, not us, we don't manage equities. But put all the money into an index fund. What do I think? What should she say to her treasurer? I said, ask him how he feels about having all his money invested in funds where nobody is thinking about which stocks should be included or what they're worth or how they should be weighted. Anyway, so I think that's a very extreme thing. It used to be that the active managers did all the work of studying companies and figuring out the prices and the weightings and all that stuff. And so if a few people came along and wanted to kind of free ride passively on their efforts, they could just emulate their decisions and not pay the research bill. That was a good strategy. But what happens when most of the people are free riding? Who do they free ride off of? That's the question that I think you'll enjoy thinking about. Now, then you want to go to the opposite end of the spectrum and talk about activists. So activism sounds like, kind of like apple pie and motherhood, activism. Isn't it good to be active? Well, activism means people who buy material stakes in companies and present themselves as agents for change, and usually insist on either a change in the way the company operates, a dividend, the sale of a unit, or seats for themselves on the board. And so far, so good. When I went to Wharton, one of the things I was taught was that one of the great advances in society, in the economic sphere, had been produced when we separated ownership from management. Because, Jay starts a company, and it's a great company, and then it passes down a few generations, and then his limited grandson still is running it, not so bright, not doing a great job. Well, guess what? Jay, the grandson says, you know what, it's not really going so well. I'm going to hire a professional manager. So he steps down, and a professional comes in and does a better job. And now we have separated ownership from management, and in general, the world does better, economically speaking. So that was considered to be an advance in those days. The problem is, what happens, as has turned out to be often the case, when the incentives of the managers diverge from the incentives of the owners? That's not a good thing, And let's say the company's doing poorly, but the managers keep voting themselves big raises, and rewarding their bad decisions, et cetera. So that's why, most investors prior to, let's say, the last 15 years ago were pretty passive with regard to the companies, and they kind of rubber stamped the decisions of the managers, including their raises, and re-elected them and so forth. And that didn't seem that satisfactory. So the activists came along and he said, we're going to stir things up, we're going to represent the owners, we're going to be active owners, and we're going to hold the managers' feet to the fire, we're only going to give them raises when they earn them, we're going to make them sell off underperforming assets or whatever it might be. All sounds really good so far. The real question, Jason, is whether these activists are long-term oriented or short-term oriented. I'll give you an example. And long-term activism is probably a good thing if they are really long-term oriented. But there's no requirement that they hold their stock for a long time. And a great example is somebody who gets control, who buys 2% of the stock of a drug company, and he says, I think that this company would report higher earnings next year if they closed the research department. So they close the research department, they fire all the scientists, the earnings go like this, but then, of course, since they run out of products, the earnings go like this, and the company goes bankrupt 10 years later. So, again, that activist had another set of interests that diverged from those of the company or of the long-term holders. So I think that activism is a good thing if they have a long-term perspective. The goal should be to make the company better, not to get the stock price up. There's lots of things you can do in the short run to get the stock price up, which are not good for the company, and those things should not be encouraged.